And in Chapter 12, we're going to discuss long-term liabilities. And the first learning objective, or the first, goal is to review a little bit about long-term notes and mortgages. A lot of this is going to be a review of some of the computations that we made with respect to interest. And we're going to add a new dimension, and that new dimension will be involving amortization tables. Okay. Now, we should know previously we reviewed this. Notes, of course, are due and payable over a period of time beyond 1 year from the balance sheet date. Again, 1 year operating cycle, whichever is longer. We also showed you that the current portion of long-term debt is also a current liability. Now, we should also remember that notes are recorded at face value. Generally, there's interest calculated on that face value. The interest calculated on face value does not begin until time passes. So interest is only earned with the passage of time. So let's review a very simple illustration. Let's assume that we have Smart Touch Learning, once again, borrows $20,000. We now have the payment, and you have to watch the wording on these. And I know a couple of people were asked, or at least one person asked me questions about this chapter during office hours, and we need to think about some of the language. It says that it is due in 4 annual payments of $5,000 plus interest. So let me just repeat that. You're making a $5,000 payment. That payment is on the principal only. It does not include interest. In other cases, like on a mortgage, your payment is going to include principal plus interest. So, for example, if anyone leases a car, or if you have someone in your family that leases a vehicle, when they make that lease payment, the lease payment includes both the principal amount and the interest on that financing. This does not include the interest. The interest is going to be separate. Okay, so the interest is separate from that $5,000. Okay, and 6% is on the beginning balance of the debt. So in this case, when you record the note, you're borrowing money. So you debit cash, as it's a cash loan, of course, and you credit the notes payable. Now, this is simply for the principal amount, and no interest will be recorded until time passes. When interest is recorded, it has to be for a period of time. In some cases, the period could be a year, it could be semi-annual, or it could be monthly. And we're going to do some semi-annual cases here. I think in the textbook you might see some monthly interest computations. Now, as we said, this is part of the adjustment process. It's considered an accrual. So if you remember, at the end of the adjustment process, we have accruals and deferrals. This is an accrual. And again, to review, interest is on the beginning balance. The interest is on that amount, and the time is either a year or a month or a quarter. Now, this is expressed as 365. I would tell you if I wanted that expressed as 360. One of the most important things in this diagram is that if you're paying down the principal, that means the interest is going to decline as the balance is being paid off. And as you might know, we'll look at a mortgage. When you pay for a mortgage, or if you ever look at a mortgage schedule, the very few payments you make in the beginning have almost no principal pay down. It's almost all interest up front, but as the principal is coming down, then of course you have less interest. So this is not a mortgage case, this is a straightforward interest case. So here it's annual and it's at 6%, so it's pretty simple. The interest is $1,200. The principal amount at the beginning of the year that you borrow is $20,000. Interest rate is 6%. This is annual, and the time is 1 or 12 over 12 if you're doing it by months, or 365 over 365 if you're doing this by days. So that's the interest. Now that interest accrues from January 1st through December 31st. Okay. Now, what we did, and this is what we saw in some of the earlier chapters. What we're going to add now is something known as an amortization table. And as I mentioned, I don't know how many of you get Blackboard. It seems like some don't, because I get an error message every once in a while that says X number of people didn't receive this email, so whatever email you're using in Blackboard is no longer active. But I did email you and say we're not going to do the appendices in this chapter. That's where we would do more of the discounted cash flow or time value of money we could pick up in other courses. So we're going to look at a very simple amortization table. An amortization table is a pre-schedule of principal and interest payments, so that in the first period you would have to pay $6,200. $5,000 goes against the principal and $1,200 goes against the interest. Now, I'm not sure how clear this is, so what I will do is put this up on the doc cam. And this is known as, and I'll make this a little larger, this is known as an amortization table. So that the beginning balance of the debt is $20,000, that's at the end of the year. The end of 2014 is the beginning of 2015. The payment is going to go against the principal amount, but the interest is calculated on the beginning balance, so that you have 6% on the beginning balance, or 1.2, and when you make this payment, $5,000, you pay $6,200, $5,000 goes for the principal, and $1,200 goes for the interest. When you start the next period, the ending balance of 2015 becomes the beginning balance of 2016, so now the interest is 6% on $15,000. Now, in this example, the principal payments stay the same, and the interest is on the outstanding balance. So, in this case, it's 6% of 20, 6% of 15, 6% of 10, and 6% of 5. So the interest declines as the principal is being paid off. And this can be done in advance. This is known as an amortization table, and it's prepared in advance so that all you need to do is make the journal entries at any point in time. Now, this amortization table, again, is relatively straightforward because the principal payment is independent of the interest. In some cases, the payment that you're making has to be split, which we'll show you, between principal and interest. Another important point is if you were doing the balance sheet as of the end of 2014, you have to remember that if I'm looking now at this balance sheet at the end of 2014, I know that since I'm paying $5,000, $5,000 would be a current liability, and $15,000 would be a non-current or long-term debt. So remember, we said that the current portion of long-term debt is going to be a current liability, and the remaining balance is going to be long-term. So on the balance sheet at the end of 2014, that $20,000 gets split, $5,000 current, $15,000 long-term. What happens next year? $5,000 is current, $10,000 is long-term. So every year, $5,000 would be a current liability as part of the payment of that debt. So now we can use this table to make entries each year. So in the first year, let's go back. In the first year, we're going to have to pay out $6,200. $5,000 goes against the principal, and $1,200 is against the interest. So taking that portion of the amortization table, the interest expense would be $1,200, and the payment of the debt would be $5,000. So the journal entry that you would have to make here would be to debit the notes payable for the $5,000. You would debit interest expense for $12,000, and the cash credit is going to go to $6,200. And we can continue to use that table to make the next entry. So, for instance, let's go to the next year. So if I wanted to go to 12/31/2016, although it's not shown, so the next year is 12/21/2016, what would happen? I would be paying out $59,000, I would have $5,000 against the principal, and $900 would be the interest. So at 12/31/2016, what would be the entry? The entry would be an interest expense of $900. Then you'd have notes payable of $5, because that doesn't change, and then we credit cash for $59. Okay. So at 12/31/16, that would be the entry. The next period, you do the same thing, except now the interest is $600 and the cash payment is $56. So the whole idea of an amortization table is to pre-schedule principal and interest payments. And once if anyone knows how to use Excel, and you take a look at a mortgage schedule, you can just build in the formula and then program it, and you could have the table. Yeah, Matt? Want to come over? Yep, what's that? Say that again? No, it's always on the interest is always on the outstanding balance. But what will happen, so the question is interest always on the outstanding balance, or is there ever interest on the $5,000? Technically, there is interest on the 5 because it's built into the 20 and it's built into the 15. But what we're going to see going forward now, when we look at mortgages are quite different because a mortgage payment has to be split between principal and interest. So the mortgage payments will be split between principal and interest. So again, these tables can be developed in advance. Typically, you could do it on Excel. Once you understand the table, you can build one of these as an Excel spreadsheet. Okay. All right. Now, any other questions, incidentally? Any questions on the note payable, where the payment does not include the interest? Interest is on top of that. Now, the mortgage is a little different. On a mortgage, you're going to have monthly payments, but those payments have to be split between principal and interest. Now, a mortgage is simply a note that is secured by an asset. Now, the most common case that you'd be familiar with is a home. So if you have a mortgage on a home or an office building, let's say on a home, if you have a mortgage on a home, your house is the collateral for the debt, so that the mortgage is now backed by the value of the home. And in this case, let's assume that they bought a building for $150, they used $49,925 in cash, and $100,075 is the note payable. Now, the interest is going to be for 30 years, and the payments will be $600. But the key difference here is that the payments will include both principal and interest. So when you first borrow, you're going to debit the building for $150. That's the historical cost, which is the sum of the assets and the liability. So you use $49,925 in cash, and the balance goes in the mortgage payable. Now, in this case, there's a big difference between the amortization table that you saw before and for the mortgage, because now you have to split the you have to split the payment between principal and interest. So let me put this up on the screen, and I've highlighted a couple of things for you. Okay. So let me try to bring this in a little bit more, if I could. Now, in this case, the problem is quite different, because in this case, you're going to be paying $600, but that $600 includes both principal and interest. Now, in this case, the interest is going to be 6% on the opening balance. The beginning balance is $100,075. 6% of that is going to be the interest of $500.38. The difference between your total payment of $600 and the interest becomes the principal pay down. So in this case, with a mortgage, or if I tell you, even on a note, so I just want you to be very careful, whether it's homework or an exam, if I tell you that the payment is $5,000 plus interest, then you don't have to worry, because then you pay down the principal at $5,000 and the interest is on the beginning balance. Here I'm telling you the payment is $600. It includes both principal and interest. So if you take 5%, or 6% rather, 6% of the opening balance, you get $500.38. The difference between your total payment and your interest is the principal pay down. And the balance after the payment of $99.62 is shown as the ending balance. Yep. Yeah. Well, it's just the difference. Yeah, there it is. There's $99.62. Right? Yeah, it's the difference between the total payment and the interest component. Right? And that's the $99.62. Don't forget the interest, which is here. The interest, which is the $500.38, is 6% of the opening balance. So if you look up at the screen, you'll see the computation. And the ending balance, I'm just going to slide this up. The ending balance down here is the opening balance minus the principal payment. Now, this note, I know it's hard to read, but I'll tell you what it's saying, and that is, as I mentioned before, if you look at a mortgage, what happens is that the early payments are mostly interest, and the early payments pay little of the principal. As you start to move down, you start to pay more of the principal, and the interest goes down. So that your very last payment on a mortgage has very little interest in it. In the beginning, you're paying mostly interest, so that you have very little equity in the home. So if you take out a home mortgage, your first year or 2 years, you almost don't put a dent in the principal. You're paying almost all interest. So the mortgage is front-loaded on the interest. All right, so on this case, the payment is fixed at 6, and you have to split the payment between principal and interest. Yep.
So the interest was 6%. So are you taking 6% of 100,000? Because that's not 600.
No, it's 6% of. It's for a month. Yeah, it's 1/12. Right. Yeah. A good question. So again, the question is, it's for a month. It's monthly payments. Okay. So these are monthly payments, and you have to basically prorate that by 1/12. Okay. Sorry, I should have mentioned that. Yeah, it's important. Real important. Okay. All right. Now the interest or the actual payment or the journal entry is going to be pretty much the same. So that first month, the first month is January. So in the first month, you'd have mortgage payable. $99.62. You'd have interest expense. And that would be $538. And then cash. So the entry turns out to be the same in format, but the way you get the numbers would be significantly different. And again, good point, it is interest on a monthly basis. You could also prorate the interest rate as well. So you could take 0.5% per month if you wanted to. Okay, so what you could have done in this case, this is for January, so if you took 6% and you divided by 12 or monthly, it's 0.5% per month. Or 0.5% per month. That would be a monthly interest. All right, so any questions on the difference between, and I'm going to go back and do one more of the simple case where the payments do not include interest, but for the mortgage, they do. And it depends on the wording. I know we did this during office hours today. A lot of times the wording, you have to look at it a couple of times, but if it tells you that the total payment If the total payment is $600 per month, that includes both principal and interest. Okay. All right, now let's try one additional example. Okay, so here's an additional example. And it tells you that we have Fox Corporation that signs an $80,000 4-year 4% note. The payments are annual of $20,000, principal plus interest. So that payment does not include interest. It's a principal payment only. So that if you look at the calculations, in the first year for the $20,000 note, interest is going to be, for the $80,000 note, the interest is going to be 4% of 80, or $3,200. The principal pay down is 20, and the total payment is 23.2. In the second year, you still have the same payment, but now the principal is down to what? 60. All right, so remember, if you paid down 80 in the first year, or if you had 80 in the first year and you paid it down by 20, then you got 60 left. So that the interest is 4% of 60. Next year, it'll be 4% of 40. But as we said, you could build this into an amortization table. Now, what would be the entry? Let's take the entries for those 2 years. The first entry is 12/31/14. Second entry is 12/31/15. So what would be the entry for the first bullet? What would you need for the first bullet point? Okay, you got a $20,000 payment, so you debit notes payable, you debit interest expense, and you credit cash. So the way that would look is very similar to this one, right? Except in this case, in 12/31/14, you have to debit notes payable for the $20,000 payment. You have interest expense, and this is annual, so it's 4% of the 80 or the 32, and cash. Okay. And then the next year, got the notes payable. Once again, you're paying it down as a constant pay down. And notice the difference again, the mortgage, this is changing every year, the principal amount you pay down. Here the interest expense goes to 24. And the cash is 22.4. Okay, so those would be the entries that you'd make in this particular example. Okay. Now one of the entries, of course, is on the next slide, we didn't have the 2015. So introduction, again, to interest or the computation. Any questions on that introduction before I ask you a couple of questions? Okay. And again, that's the entry that's on the slide. That entry, of course, on the slide is for 2014. I just added the entry for 2015. Okay. All right. All right, so the first question you see there, says the amount of interest paid each period on long-term liabilities remains the same, as well as the principal payments and the total payments. So this one should be easy. Should be easy, but we want to discuss it if it's not. All right, close enough. Looking for 100%, but it is false. So let's go through this. All right. Now you have to remember that the interest paid has to be different. So number one, this statement is loaded with false information, so that the number or the amount of interest, the dollar amount of interest you pay each period will change every time because the principal payment is going down. Principal payments could be the same, but mortgages, that's not true. In a mortgage, the principal payment will increase as time goes on. You pay more principal as time goes on and less interest. And the total payment may or may not be the same. So that in this case, for example, let me go to the doc cam if I could. There you go. Did it go on? There it is. Okay. In this case, the interest, of course, is different. The total payment is different. But again, the principal payment may be the same in this case. When you go to a mortgage, the monthly mortgage, notice that principal payment changes and the interest changes, but the total payment stays the same. So it's possible that the total payment could stay the same, but certainly interest and principal amounts may vary depending on the type of debt. Right.
Is there ever a time when the interest is always in the beginning balance?
Always. Interest always has to be in the beginning balance.
No, like after every year. Like, this is interest amortization,
Right.
So is there ever a time where you're always going to pay interest on the $80,000 you borrowed?
Is it always going to be on the unit task? Only if you're not paying down principal. All right, so here's a good question. Do you ever always pay interest on a constant balance? Yeah, as long as you're not paying down principal. So if you don't pay principal down, it could be the case where the interest stays the same. Okay, in our examples, we're assuming we pay some of the principal. Okay. Now let's try another one. All right, so this one, we have a company on March 1st issues a 5% long-term note for $20,000. It's payable over 10 years, $2,000 principal installments at the beginning of each year, beginning on March 1st. And each annual installment will include both principal repayment of $2,000 plus the interest for the 1-year period. The journal entry to pay the first installment will include a debit to interest expense of $1,000. Is that true or false? Now remember, this is the journal entry to pay the interest, not the year-end accrual. It's to pay the interest. Okay. All right. Not true. Okay. Yeah, so very simple. Very simple. It's that one, get that out of the way. Okay, it's just simply the 5% on the $20,000 for 1 year. Okay, just two more. This one, I'm going to give you the answer. I mean, this one, yeah, this is the definition of an amortization table. That's true. So let's go back to this question, and this is the Next Vantage Services. Again, a 5% note payable for $15,000, payable over 3 years, $5,000 in annual principal installments on March 1. How will this information be shown on the balance sheet? This is not asking you for interest. It's asking you for the balance sheet disclosure. Okay. Let's see. All right. Okay. This is something we did. We did it about 15 minutes ago. If you have a $15,000 debt that's payable in $5,000 installments, at the end of the year, it should be split. 5,000 should be current and 10,000 would be long term. You haven't paid. This does not include any interest. There would be accrued interest on that you were not asked for at this point. So the answer there would be C. Okay. All right. Okay. Now, just quickly, I will tell you that the answer to this one is true. That it's simply it's a very simple payment. Okay. All right, so we're going to move on. Any questions on calculating interest before we go ahead? Any questions on the basics of calculating interest? We're going to go back to amortization tables in a bit. All right, now the primary focus of this chapter will be accounting for bonds. Now, bonds are actually nothing more than long-term notes. So let's go to the definitions on the next slide. Definitions tell us that a bond is simply a group of long-term notes that are issued to multiple lenders. So that a bond is a group of individual promissory notes that are sold. So that if Apple wants to borrow from the market, if you're an investor and you want to buy Apple bonds, you're actually lending them money. The bond issue could be 100,000 bonds. The bond issue could be 300,000 bonds. Instead of going to a bank and signing an individual note, when you issue bonds, you sell them in multiples so that you may sell 100, 1,000, 3,000 bonds. A lot of people, individuals issue bonds. David Bowie, the entertainer, had Bowie bonds, if you ever heard of those. He borrowed money by issuing his own bonds. So you're borrowing from the market. Each promissory note generally has a par value of 1,000. Now the question is, of course, we know that par value is also called the face value. But the question is, how are the bonds going to be priced? Because you don't always pay that face value. And what you need to do is take a look on the right side at some of these definitions, because the face value, and there's a picture of this in a slide that's coming up, but that's the stated amount on the bond. Most bonds carry a face value of 1,000. There's an interest rate on that bond. That is the rate of cash interest that you're going to get. That is known as a nominal rate or a stated rate or the coupon rate. The reason why it's called a coupon rate, it's sort of an antiquated term. Maybe about, maybe 100 or 90 years ago, you used to be able to take the bond and rip off a piece of paper, which was a coupon, like a piece of paper. You'd bring it to the bank. That's how you got your interest. Today, of course, everything's done electronically, but it's still called coupon interest. That's the cash. The issue date is the date the bonds are sold. The maturity date is the date that the bonds are paid back. Payment terms, we'll talk about this. They could be at the end of the bond or they could be periodic. And here's the last and most important definition. The market or the effective rate. That is the rate of interest that is currently in place on the date you issue the bonds. That is your alternative investment. So instead of buying my bonds, you could buy a comparable bond for the market rate. Now, when you look at this last bullet, it tells you that the bonds are priced based on the relationship between the market rate of interest and the coupon rate of interest. Now, again, the coupon rate is stated on the bond certificate. So it tells you it's a 9% bond in this example. It's stated on the bond certificate. The bond certificate or the bond contract, which is sometimes known as a bond indenture, a bond contract, would also tell you the types of bonds. Bonds could be secured. They could be like a mortgage backed by assets. Debentures are unsecured bonds. They have no collateral. A debenture is backed by the general credit rating of the corporation. So, for instance, Apple could issue a debenture bond. Apple could issue debentures. Why? It's backed by the quality of the company itself. It's not backed by a specific asset. In the event that a company has a lower credit rating, you may need to back it up by assets. You may have to pledge certain assets, whether it's property or other types of assets. A term bond, it matures in one point at the end of the term. Interest is paid periodically. A serial bond would be payable in installments. Now, the key is the bond price. The bond price, the face value of the bond, of course, is due at maturity. The bond price will depend on the relationship between the market rate and the stated rate of interest. And here you have to look at the bond as a product. A lot of people may work, at a bank or at a financial institution. If you work at a bank part-time, someone in the, on the platform, the front desks that are out there, they're saying we have new products. I mean, to me, it's like money. I put money in the bank, take it out, I got a check. But these are products. And the product will be compared to other products in the market. So that if you look at the gray box and it says that if I go to market on a date when my bonds offer the same rate as everybody else, my product is comparable and you'd be willing to pay face value. Correct? So we'll put some numbers up in a second. But let me just go back and forth here with this and tell you that if I take the market rate and I look at the face rate or the cash interest rate, if that rate is 10% and if my bonds are at 10%, these products are comparable so that the issue price will be at par or face value. The market's in equilibrium. The products are comparable. So you're indifferent between buying my bond and the other bonds, assuming all of the factors are the same. And I have a diagram like this later in the slides, but I think it's better if we look at it right now. Okay. Now, if you look at the cost of borrowing, bring this down just a bit, or your return, we'll look at this from the corporation standpoint. So the cost of borrowing here is going to be how much? What's my rate? How much is it going to cost me to borrow? It's going to be 10%. Okay? So I'm going to be at 10%. Now, if we go back and look at the box on the right, what if the market rate is greater? So I go to market with a bond at 10%, at 8% rather, but the market rate is 10. So everybody in this room looks at my offering. I'm offering you 8%, but you know you can go next door and get 10%. Are you going to give me face value for that bond? No, it's not worth face value. You discount the bond. The discount is a price below par. even though, and here's the most important, sort of the punchline here, even though I have to give, by the way, the face rate is the cash interest. That's the main thing you have to remember. That's the cash interest. The market rate is the effective interest. Okay. So, what's my cost of borrowing here? I have to pay you 8%, but here's the problem. If the bonds have a par value of 1,000, in this case, I may only give you, or you may only give me 900. How much do I have to pay you back? 1,000. I still have to give you 1,000. So even though the bonds in the market sell at 900, I still have to pay you 1,000. So let me just draw something out for you. Here's the way it's going to look. Today's time period 0, and here's maturity. I've got 900 bucks that you gave me today, but at the end of the period, I have to pay you 1,000. What would you call the difference? What's the difference between the two? I'll walk up, it's the first time a lot of you see in accounting. I usually pick on English majors, so I walk into the writing center, grab one of the PhD students and say, look, I'll give you 900 bucks now, but you got to give me 1,000 in about 3 years. What would that person think that the difference is? It's interest. It's interest, right? So the difference, the discount, is interest. The discount of 100 here is really additional interest expense. Now, we'll talk about the accounting for that discount, but the discount is additional interest expense. I want to make sure you see this from a common sense perspective. And again, just, if I offered you, I walk up to you and say, here's 900 bucks, but you got to give me $1,000 back, forget about that 8%, that is added interest. Now, I'm also going to give you the 8%. So that means the 8% plus the discount brings my cost of borrowing to what? Higher. It goes to 10%. So I'm still going to have a cost of borrowing that's equal to 10%. Now the problem is that we're not going to go into discounted cash flows here, so that we're not going to go to this higher level. You're not going to see the numbers exactly, but that additional interest means that not only do I have to give you 8% every period, I also have this problem that I only borrowed 900, but I have to pay you back 1,000. So it's additional interest. So that if we look at this diagram now, my cost of borrowing is what? 10%. It's still going to cost me 10%.
Is the interest on the 900 or the 1,000?
It's on 1,000. The interest is on 1,000. So the interest would be $8, anyway. Yeah, the interest is on 1,000. So interest is on 1,000, and I have to pay you back 1,000, but because the market conditions were such that I did not have an interest rate that aligned properly with market conditions, I couldn't get as much money as I wanted. So that I had to accept the discount. Okay. And we're going to show you numbers that will make this a little bit easier to understand, but I just want to lay out this theory first. And then finally, what do you think is going to happen if I go to market with a bond that is superior, in the sense that the face rate is higher. If the face rate is higher, you're going to pay a premium. So in other words, let's say I go to market with a bond that is at 12%, but the market rate anywhere else is 10. What's going to happen? Everyone here is going to start bidding and offering me more and more money. You'll offer me enough money until you pay a premium, which is above par. Let's say it goes to $1,200. So you might give me $1,200 for that bond, and I think you know the answer. What's going to be my cost of borrowing? It's going to be 10%. The cost of borrowing is always the market rate. And why is that? You just gave me $200 more than I have to pay you back. So therefore, my cost of borrowing has to drop. Right? If you give me $1,200 and I'm only paying you back $1,000, my cost of borrowing gets reduced. So that if I do another diagram for you, or another example, instead of having the premium case, if we go to the discount, this is going to be time period 0 again. And you now gave me $1,200, but I've got to pay you back $1,000. And I'm also getting 8%. I have to still pay the 8% on the $1,000. Right? So I'm still paying the 8% on the $1,000 or the $80. Right? So I'm still going to have to pay you $80. But notice what happens here. And when I first looked at this, I remember the professor telling me, look, you see that premium you got, is $200. Premium's $200. In reality, you can use that $200 to pay off your first 2 interest payments and maybe a little more and more in the second. So in a sense, you've got your interest payments already covered. The first 2.5 interest payments are covered by that premium. So that'll reduce your interest costs. So the premium reduces your interest expense. Okay, so again, you gave me $1,200, but I only have to pay you back $1,000. So a premium reduces your interest expense. And as I said, it's like saying that you can use this $200 to pay off your first 2.5 interest payments. Yep.
From the standpoint of the buyer,
Right.
you can technically influence the base rate, right? Because if the company is in a position where they need to issue bonds, you can, the rate isn't determined based off the corporation, right?
This is the corporation side, but I'll take the question again in a second, but let's look at the investor side. The investor has the same rate of return as my cost of borrowing. So that if you take this from the standpoint of the investor, if the investor is buying a bond that pays 8%, but only pays $900 for it, they're going to get $1,000 at the end, so their rate of return is also 10%. If the buyer pays $1,200, but they're only going to get $1,000 at maturity, their rate of return drops, and it drops to 10%. So the punchline here is that bonds are always priced so that the investor earns the market rate, and I always, as the debtor, have to pay the market rate of interest. It'll always work out this way. Now, we're going to put some numbers in here in a second, but it will always work out this way in an equilibrium scenario. Like right now, for example, I know that if I look at certain bonds in the marketplace, if I see bonds right now that are offering, so for instance, a bond could be offering 6%, am I going to be paying a premium for that or a discount? Given today's market, I'm going to be paying a premium. Right? I should be paying a premium. Market rates are like 4% roughly on bonds, on corporate debt, so that if there's a bond out there, there could be some existing bonds out there still trading. Because don't forget, bonds are issued for 30 years. So a bond issued, 10 years ago could have been at a 6 or 8% rate. If those bonds are still trading, they have to be trading for more than par value. Because right now in the market, I can probably only get, about 4% on a corporate bond. So I'm going to be paying a premium. But no matter what I pay, I'm going to wind up with the market return because I'll have to pay such a high premium to get that bond that my rate of return is going to drop. So you're always going to wind up with the market rate of interest. Okay, so again, to summarize this, if the market's in equilibrium, then the bonds will sell at par. If the market rate is higher, they'll sell for a discount. Market rate is lower, it will sell for a premium. And of course, as we said, and this is what I was trying to explain, which we'll see, the bond premiums and discounts will adjust the interest expense. Now, the bond premiums and discounts have to be allocated to each accounting period. Now, here's where it gets like sort of away from finance and economics and becomes more of an accounting problem. How do we reflect? How do we properly reflect the additional interest on a discount case, and how do we properly reflect the interest savings on a premium case? If you think about the cash basis, which you know we can't use, when do you pay that discount back? Let me go back to this diagram. On the discount case, you really pay that discount at maturity, correct? That's the only time you pay it back. The problem is we have all of these accounting periods that we have to report. That discount will be allocated to each accounting period. That allocation is known as amortization. So we're going to take a piece of that discount and allocate it to each period. The premium, because we're not on a cash basis. If we were on a cash basis, the only time we would pay that back is at maturity. If you look at this case with the premium, the interest savings, where we really collected the extra money here, and that interest savings is on a cash basis reflected at the point of sale, at time period 0. But for accounting purposes, we need to allocate that premium to each interest period. That allocation process is known as amortization. Discount amortization is going to discount amortization is going to increase interest expense. Premium amortization will reduce interest expense. And that's exactly what you're seeing here. Okay. All right, so that's what we're saying here, that the amortization of a discount will increase interest expense. Amortization of a premium will reduce interest expense. And then once again, here's a very similar example. I had very similar numbers to help you understand the difference between a premium and a discount. Okay? All right, so we're going to look at some numbers in a second. By way of introduction, just wanted to give you the concepts. Now I'm going to ask some questions about the concepts, but before I do that, do you have any questions or other questions regarding the nature of the discount? Yeah. Premium is a price above par value. Yeah, premium is above par, a discount is below par. Okay, so any other questions? All right, so let's do this. Want to know, when will a bond sell for a premium? You want to see how much we picked up over the last couple of minutes. Okay, so when would a bond, what conditions will determine a premium, a price above par? Now remember, the stated rate is the face rate or the coupon rate, all the same. Okay, very good. All right, that's easy. Yep, stated rate is higher, that's the premium case. Stated rate is higher than the market, that's the premium case. Okay. Discount, not going to do this one. You should know if you got that one right, you're going to get this one right. Stated rate is less than the market, so the answer again would be C in this case. Okay. Let's do one more. Okay, the interest rate determining the cash interest. What's the term that we use? This one should be easy. Oh, jeez. Come on, man. Oh, come on. Cash interest, cash interest. Cash interest is the stated rate on the bond. You always get the stated rate on the bond. C. Come on, man. I don't know. Okay. All right, so the market rate is the rate that determines the bond price. That's the rate, that's the next question that the market demands. The stated rate is the same as the face rate, the coupon rate, the cash interest rate. That is the rate that is stated on the bond. Okay. All right. Sorry. Stretch that out. Okay. Any other questions? We're not going to ask any more. Next one's easy. Just the opposite of the other questions. That one is C. You have to sell for a discount. And the last question is the interest rate investors demand is the market rate. The coupon rate, again, is the cash rate. Yield to maturity is something different. Differential rate is just a throw-off item. So the answer to that is D. Okay, that's D. All right, now, here's the sort of the main event for today, and that is to account for bonds and account for the premium and the discount. So this is where it's going to get a little tough now because, as I said, all the economics and the financial theory and the ideas of investing, now we're going to put that aside, although it's certainly an undertone with respect to the foundation. We're going to use straight line amortization. Again, as I mentioned, we are not covering the appendices which deal with present values, time value of money. All right, so let's go through an example. It's the best way to see this. Smart Touch Learning is now going to borrow in the bond market. They issue $100,000 worth of bonds. There are tons of bonds in that issue. That's not just one bond. There are 100 bonds in there, actually, with $1,000 par, for example. 9%, they mature in 5 years. They issue them on January 1 of 2014 when the market rate is 9%. Now, what you have to start to be able to do is to say, all right, market rate's 9, the face rate is 9, they have to sell at par. Right? So that's something you should know. That these, do a logic check or a reality check when you look at these numbers. So the bonds would have to sell at par value. Okay. So again, in this case, when you borrow, you're just going to debit the cash account and credit bonds payable as if it was a note. It's exactly the same as it would have always been. And in this case, of course, if you look back at the question, it doesn't really tell you, but the bonds are assumed to be semi-annual. Most bonds are going to be semi-annual, so they're paying interest twice per year. So in this case, what you would do is you would have 2 interest periods. So in this case, the par value is $100,000. The stated rate is 9%, but because the bonds are semi-annual, the rate goes to 4.5%. Okay, so the rate goes to 4.5% on the bond. And this is the semi-annual cash interest. And this again is the semi-annual cash interest. Remember, this again is the stated rate, coupon, or face rate. Exactly, always the same, no matter what the market rate is. This is the rate that is stated on the bond certificate. Okay. Now, how would you record the interest expense? Now remember, They said the bonds, I believe, were 5 years. Is that correct? Right. So how many interest periods do you have? The number of interest periods, you got 5 years, but it's semi-annual. So you have 10 interest periods. Interest is paid twice a year. Interest is paid twice per year. So you're going to be collecting $4,500 every 6 months. And the corporation will have to pay $4,500 every 6 months. So in this case, the entry would be interest expense. And credit cash, and that'd be 45. Okay, 45, right. Okay, 4,500 is your interest expense. There's no principal pay down here right now. So principal is paid at maturity. All right, so that is a bond that sells for par. And that's the base case or the foundation case. We're now going to look at a bond selling for a discount, but we can't move on unless we clear up your questions here. Any questions regarding bonds selling at par? Market rate's 9. I'm giving you 9. Everybody's happy. We're in equilibrium. Semi-annual rate is 4.5%. The bonds are 5 years, but since it's semi-annual, I got 10 periods where I have to pay the interest. And at maturity, I'm going to pay you back the $100,000. So we had a question, Mary had a question before about that in a lot of cases, especially bonds, you don't get the principal back until the bonds mature, or unless they're paid off early. In some cases, bonds could be called, and that happens a lot today. For instance, if you look at, I think Toyota had bonds at 6%. They called them about a year ago. What does that mean? In the bond contract, if I held Toyota bonds, I know that beginning in 2013, they could call the bonds and pay me off at that point. And I'm willing to take that risk at 6%. Toyota probably figured, well, why should I keep paying 6%? They called in the bonds, gave the investors back their par value, and they walk away from the 6%. If they need more money, they could borrow today at about 4%, right? So you could pay off the bonds before maturity, but if you pay them out at maturity, you pay back the face value. Okay. Now, let's go to a discount case. Discount case, market rate is higher than the stated rate. Now when we start to do the recording, we get involved with the debits and credits again. Of course, on the screen would make some sense. So let me do that. Okay, so when we record bonds at a discount, it means that the market rate of interest is greater than the stated rate. Therefore, if I can get more in the market, I'm paying less for the bonds sell for a discount. The bond is recorded by recording the par value or the face value in the bonds payable account. We now use a contra liability, which is known as the bond discount. The discount is amortized over the life of the bond. That amortization will increase interest expense. And when you increase interest expense, which I'll show you in a moment, you are actually bringing the effective cost of borrowing up to the higher market rate of interest. So the bond discount is going to be a contra liability. It will have a debit balance, and it goes on the balance sheet along with the related bond account. To see this, let's take an example. This time, Smart Touch Learning has the same bonds, $100,000 bonds at 9%. 5 years semi-annually, but now the market rate is 10. With a market rate of 10%, I am not going to give you face value for those bonds. The bonds will sell for a discount. The bonds sell for $96,149. If you look at the quotation, 96,149%, that is the quotation, so that if you open up a web page looking for bond prices, you'll see them quoted at 96.149, that means that it's a discount. That is the percentage of par value. The bonds are priced to yield the market, and in this case, the discount is going to be 38.15. The way the discount is calculated is to look at it this way. It's the issue price of 96,149, and of course the par value or the face value is 100,000, and the difference is the discount. And that is a contra liability account. So when you record this, we have to set this up by ensuring that the par value stays in the bond account. The amount of cash I receive is 96,149, and the discount is debited for the difference. So let me show you that in the journal entry. You should have it with you, but there's the journal entry. So you debit cash for the amount you receive. The debit to the discount represents the contra liability that is going to offset bonds payable on the balance sheet. The bonds always get recorded at par or face value. So the bonds are always recorded at par or face value. Now, in the accounts and on the balance sheet, let's go back to the T accounts. The T accounts will look like this. You're going to have the bonds payable. This is in the general ledger. Remember what that is, I guess, right? Haven't seen a T account in a while. The bonds payable account has a credit balance of 100,000. The discount is the contra liability that has a debit balance of 3851, and the carrying amount on the balance sheet is 96,149. So the balance sheet will reflect the 96,149, and you'll see it on the balance sheet in the long-term liability section as you see it on the screen. Now, that is the initial recording. That is not, obviously, it's not dealing with the amortization, but that is the initial recording. So the bonds payable at par minus the unamortized discount, and that would give you the carrying value. Now, our objective, when we start looking at amortization in just a minute, the amortization is going to do two things. The amortization is going to reduce the discount. As the discount goes down, what happens to the carrying value? It's going to go up. So your objective is going to be to bring the discount down and bring the carrying value up. At maturity, what should be the carrying value of that bond? On the day I pay it off, how much should be there? 100,000. In other words, what we want to do, one of our objectives, is to get that discount account down to zero, and therefore what is left on the balance sheet will be 100,000 on the day I pay it off. And that's at maturity. I could pay it off before maturity. Well, let's assume we pay it off at maturity. So that's my goal. The other objective is to adjust interest expense so that it reflects the higher market rate. And we do that together with the amortization process. So let's talk about the bond amortization. The bond amortization will be over, as I said, 10 interest periods. The 10 interest periods come from the 5-year semi-annual. The semi-annual coupon rate is 4.5% or $4,500 per period. We are going to amortize the discount on a straight line basis. So every period, we're going to adjust interest expense by $385. At the same time, we're going to bring the discount down by that amount. So the discount will drop by $385 every period, and interest expense will go up by that amount. So that the interest expense, as you can see, will be $48.85. Cash interest is $4,500, and the discount adjustment to bring the interest expense higher is $385. So I'll show the entries in a minute, but by making the entry to amortize the discount goes down, the bond carrying value goes up, and you have 100,000 at maturity. And again, the total interest expense is going to be the sum of the discount amortization plus the cash interest. So let me put this up on the doc cam, might be easier to see. So what happens is that we take the opening balance of the debt, which is the 96,149. The dates, of course, are 2014. Move that over just a little bit. Okay. The interest payment is $4,500. The discount amortized, as we said, is given to you at $385. The total interest expense is $48.85. Now, let's make sure we know what's going on that table. First of all, when you look at the numbers, this is the interest. How did you get that? It's 4.5% of par value. So remember, this is always 4.5% of the $100,000 par. This is the discount of $38.51 divided by 10 periods. And this, of course, is the sum. So the total interest expense is the $4,500 plus the $385. Now, as the discount is amortized, notice what happens is that the debt balance goes up. So that, in this case, 96,149 is your opening balance. If you take the 385, the discount brings the debt up to 96,534. Okay. So it brings the debt up to 96,534. And this will continue, and if you look at the amortization table, this will continue until the bonds are brought up to par value at maturity. So that every period, interest expense goes higher by $385, and the bonds will go up by $385. And again, let me just show you when we get to the punchline down here, it's going to be, you keep amortizing the discount until it goes to $100,000. Okay? So the bonds are going to be brought up to par value on the date of maturity. Okay. All right, so the bonds are brought up to par value on the date of maturity. Now let me show you the journal entry. The journal entry will debit interest expense for $48.85. You credit cash for $4,500, and you credit the discount. Now, one of the things that you're not going to see precisely here because we're using straight line amortization, but what you have to think about conceptually, when you're debiting interest expense for $48.85, that reflects the market rate of interest. That's like saying that's the 10% that I'm paying on a market basis, or semi-annual, that's the 5%. The cash interest is the 4.5%, and the discount makes up the difference. So if you look at this entry, the debit to interest expense is reflecting the market rate of interest of 10%. So you're incurring the higher rate, but you only pay interest on the stated rate of interest. And as you credit the discount, notice what happens. This is after 1 year. As you credit the discount starts to go down and the carrying value of the asset goes up. So that after 2 interest periods, now one of the things I really have to make sure you pay careful attention to this. If you're asked a question for the first interest payment or period, it's 6 months. If I want it for a year, it's 2 periods. So this is where people make tons of mistakes, like on the final, or on homework coming up, or on the quiz coming up online. If you're asked for the first year's interest, it's the sum. First of all, the cash interest is how much? $9,000, and the discount amortization is the sum of those 2 numbers. So you have to make sure you understand that this is a semi-annual bond. And of course, on the balance sheet at that point, you would be reflecting 96,919, which is the balance after the first year. The balance after the first year, let me show you again here, is going to be 2 periods. So make sure that, and this is the last point I will make, but make sure you get this before we leave, and that is that the first year, from January 1st of 2014 to December 31st of 2014, you've got 2 interest periods, not 1. All right, so we'll pick this up on Friday with the premium case.